Like to give everybody just a minute to get tuned in and turned on. I'll go through a couple of the ground rules for this evening's presentation. First of all, it's a good thing that if you're able to hear me, you should see on your screen how to use the new market manipulation to your advantage. My name is Don Kaufman. I'm going to be your host this evening. Feel free to chat in here if you do hear me all right. So quiet. Yeah, you guys do hear me. That's for sure. Got quite a number of people on this evening as well. I also am always curious where everybody's joining us from. By the way, I always start that way because it's always my own curiosity. We're going to challenge you guys a little bit tonight. A few things I like to get out of the way right up front. Number one, everything we do this evening is recorded. That inevitably comes up as a question. Okay, so of course everything we do is recorded. If you would like my slides, we can make those available to you in a PDF format. So the slides are available. Everything's recorded. With that, can you ask questions? Sure, you can ask questions, but just so you guys know, very often I'll prompt you for questions along the way. It's kind of difficult at times to, be reading through a couple of these slides. I'm going to do a few live examples and so forth, but for questions, it's not just me answering them. So we've actually got a number of support staff. So one of the other traders has joined us tonight, actually two of the other traders. So we've actually got Jeff involved here tonight, and we've got Doc Severson. So Doc is another options geek. He also is into technical analysis. So again, all the above here. So all right, let's officially get things rolling tonight. How to use the new market manipulation to your advantage. Again, a few things I like to always cover up front. We are not financial advisors or broker-dealer. The reason I always throw that up there as a risk disclosure initially is if you've never actually been to a presentation that I have done before, number one, I tend to speak rather quickly over there, right? Okay. For those of you that have ever heard me before, you probably know that. I speak kind of fast out there. I'm coming to you live from Scottsdale, Arizona. That is a picture of me, slightly unshaven. Again, my name is Don Kaufman. I'm the co-founder here of TheoTrade. But again, the reason I threw the disclosure up there, I spent the previous portion of my career. I'll give you guys just a brief overview of my career. So in the late 90s, first of all, I grew up around trading. So, pretty much my entire life I've been in and around trading. In the late 90s, I got out of college. 3 weeks out of college, I was invited to clerk in Chicago. Showed up in Chicago, yada, yada, yada. 3 weeks after getting out of school, I never left. One of the best pieces of advice I ever got is a couple of traders that I knew said, hey, kid, don't be involved here on the trading floor. You got to go upstairs. You got to get out of the trading floor because the trading floor is going to be gone. So it was only about less than 2 years later, less than 2 years after I started in the industry. I traded on the professional side for years, managed risk. They moved me upstairs, which was a pretty good position for a kid that was 22 years old at the time. Anyway, they invited me to a no-name startup firm, and that no-name startup firm was called thinkorswim. So obviously I have thinkorswim experience. I was one of the original shareholders of thinkorswim. Went on in my career to work with thinkorswim. I ran their entire education division for umpteen years. We did a number of acquisitions. Eventually, thinkorswim was acquired by none other than TD Ameritrade. I actually ran the education division for 7 million clients of TD Ameritrade for over 5 years. And so that's a little bit about my background. The entire time I worked at the brokerage firm, I was also still a very avid, very active individual retail trader. So a little bit about myself and my background. A lot of the insight and experience that I'll bring to you this evening, it's not just my own experience, is recognized when you're working at a firm like a thinkorswim or a TD Ameritrade. So you guys know they have the largest options order flow in the entire industry, bar none. And you get to actually study clients when you work at a brokerage firm. And it's been some of the most insightful, really experience that you can get out there. So with that, I like this one. People always ask, have you ever done the CNBC thing? Been there, done that. And they pitted me against, of course, Mr. Wonderful himself, but I always like the saying, trading's never about being right or wrong, but when they put you up against Mr. Wonderful, I'm right, and he's most definitely wrong. So this was, the shot was actually taken back when Apple was very close to its all-time highs, and I was absolutely on the short side of Apple. I'm no longer in that that particular position. Nevertheless, let's move onward and upward. Okay, you guys ready? Yeah, everybody? By the way, this is an interactive session. Jump in at any time. Got a lot of people on here tonight, so I'm telling you right now, okay, we're going to throw a lot at you tonight. And I worked a very, very long time on this presentation. So let me kind of kick it off with this. All right. Market manipulation. Manipulation to me is an extremely strong word when it comes to the markets. You know, none of us, including myself, I never wanted to believe that, you know, the markets are manipulated or controlled. And I'm going to explain the type of manipulation that we're going to be discussing tonight. And I'm also going to show you statistical evidence of the manipulation. That's the most important thing. Anybody can come out and go, the market is manipulated, which is ridiculous. But if they have statistical data to back it up over here, well, it's going to be a different thing. In the next 45 minutes, I'm going to educate you on, number one, how the market manipulation ultimately occurs, why manipulation is par for the course right now, and strategies you can take advantage of, okay, this more recent market manipulation. So, everybody all right? The other thing, and I like to be very upfront with this, okay, and that's this. Are you willing to put forth the effort? So, the following course material can be extremely demanding to learn tonight. Okay, and I'm telling you this up front. This course, it's not going to be some chart pattern or follow the bouncing ball with red and green flashing lights and arrows. Okay, all that stuff these days is ridiculous. You have to realize in this industry what you're trading against. Everybody's got pattern recognition software, like the professional side of the world out there. Okay, oh, excuse me for a moment as my screen has gone green. All right, we are good. I do apologize for the imminent delay over there, but yeah, there was a little bit of a technology issue. So, all right, make sure everybody's tuned in, turned on. Yeah, it happens from time to time over there. Wow, that was like lime green though. Oh, you know, keeps you going. All right, so as I kind of get into this, as I was saying again, are you willing to kind of put forth the effort? So I'm putting together this entire course, and some of the material in here takes a tremendous amount, literally a tremendous amount of research to be able to do. And the one thing that really struck me is, you know, the last time I did a presentation similar to this, somebody's like, well, is it going to be a pattern over here? You got to realize, again, the other side of the business. When I say the other side of the business, that the professional trading world, you know, when it comes to charts, they've got pattern recognition. I mean, they're using all kinds of artificial intelligence these days, right? And I just say, if you really want to learn this business, you got to be willing to put forth some effort. Okay, this is not going to be instant coffee, instant tea. This is a skill set, and everything I'm going to do is based on statistical data. I am what they term a quantitative trader. It means I'm a numbers geek. Okay, and what we're about to discuss involves market makers, it involves hedging activity, and recent changes in market structure. And let me tell you guys something. This right here, that's a big one. The recent changes in market structure, I'm going to hit on. So with that, I challenge people here. Let's get in the know. You may not know where the markets are going, but you can measure how far markets can move within a given period of time. This quote-unquote normal fluctuation is what we term expected move. Okay? So I start with that over there. This normal fluctuation is what we call expected move. Now, I'm going to explain expected move in quite some detail. What to expect with expected moves. And you're like, well, what does this thing mean? All I want to know at this point, and I'll explain this slide, is I don't need to know precisely which direction the marketplace is going to go, because that's what everybody in the world is looking for. Tell me which way it's going to go. Tell me. Okay? Well, if you believe in what they call randomness, all right, well, that's a good thing, and that's fine. Okay? And there are times in the market where you can get a really good directional feel. But what we're going to do tonight is we're going to use statistical analysis for what they term expected move. And that's expected move. It does not tell us which way the markets are going to move, but it does tell us the approximate movement, okay, an equity or index product is likely to encounter within a defined period of time. Okay? Now, what that basically means is if you look at a stock and you say, it's Apple, okay, you might not know which direction Apple's going to go. Got it? But could you tell me between now and let's say the exact date, between now and December 31st, the end of the year, I need to know how far is the stock capable of moving. What that basically means, and I'm going to provide very detailed explanations tonight, but if you looked at Apple, A-P-L, and the big question mark is how far could it move? If I could tell you it could move up $5 or down $5, would that information be helpful to you? Okay, anybody? By the way, please chime in. All right, that's again, these are not rhetorical questions. If you're here tonight, I want people to actually learn this stuff. All right, and the answer is, of course, it's going to be huge information. And that's what we're actually going to do. And I'm going to show you statistical analysis around this. And I'm going to tell you, some of the stuff is crazy cool. And by the way, what I'm showing you here, initially, this is not brand new. This has been around for decades and decades. But I am going to have to get through this to get to the stuff that is brand new. When I say brand new, they just changed some market structure. Okay, so get ready for expected moves. Expected moves explained. Now we're going to spend a little bit of time on this chart. Okay, and what is this? This is really, it's not really a chart. What is this thing? It's a distribution curve. Why am I going to spend time on it? Because it's the best way that I know to explain expected move. It's simply the best way to explain expected move. So here's a stock. Now, the reason I like to use a distribution curve like this, and the distribution curve, okay, and I'll blank this thing like 5 different times, but this distribution curve, the really cool thing about it is, okay, for the most part, it gives no directional bias. Like here's a $100 stock, right? It says, well, the chances of it going up here are pretty much the same as the chances of it going down here. This is also what you guys know as a bell-shaped curve. What does a bell-shaped curve do for you? Well, I guess everything you do in your life kind of fits into a bell-shaped curve, right? There's really, really good drivers. Those people are like way up here on the curve. Then there's really, really bad drivers. By the way, everybody believes the city they live in, everybody's a terrible driver. But if everybody's a terrible driver, then everybody fits into what we term the meat of the curve. What's the meat of the curve, right? If everybody's terrible, then everybody's pretty good, okay? The meat of the curve is what we call a normal occurrence. And somebody already chimed in over here. It's approximately 68% of occurrences. You're like, well, where do you come up with that number? That's one standard deviation. Now, the 68% tonight, it's not critical. All it basically says is, okay, whatever you do in your life, all right, there's going to be excelling at it, there's going to be not so good at it, but the most of us, which is 68% of us, fit into the meat of the curve. That's it. That's what the bell-shaped curve is about. Good? Okay? And the reason I love doing the bell-shaped curve is because, again, every single seminar you go to, they're like, don't worry, I'm going to tell you which way the stock is going to go. Yeah, good luck with that. I mean, you see how random markets are. But expected move can tell you something extremely important. Now, bear with me as I teach this, okay? We have a stock. We're going to say the stock is trading right at 100, okay? And on most liquid stocks, okay, on most liquid stocks, we have what are termed options. Now, some of you guys are familiar with options. Some of you are not so familiar with options. That's okay. Okay? I am going to talk a little bit about options tonight. Do not let that persuade you. That's usually when people are like, that's it, out of the contest. Calm, breathe. You're not going to have to understand options in detail to understand expected moves. But the options marketplace is what's driving what is termed expected move. Okay? I'll explain it this way. Here's a stock that's trading at 100. And I always call every stock, if this is like a, instead of ABC or ZXY, I call it This stock is actually called stock, and this stock has an option on it. Now, one of the options is what we term a 100 call. There's another option on here called a 100 put. Now, what's a 100 call give you the right to do? It gives you the right to buy the stock at 100. The 100 call gives you the right to buy the stock at 100. The 100 put gives you the right to do what? It gives you the right to sell the stock at what? At 100. Now, why am I looking at a 100 call and 100 put? Okay, let's say in this example, I'm going to make this very equidistant. Let's say the 100 call is trading at $3. And, okay, $3. Now, what does that $3 give you the right to do? It gives you the right to buy what? Buy the 100 call. The 100 call gives you the right to buy the stock at 100. Why is it trading for $3? Why is the 100 call trading for $3? Again, these are not rhetorical questions. You know, there's hundreds and hundreds and hundreds of people on over here. You can chime in. Why is it trading for $3? Because that's what the market set it at. Okay? This price on an option of $3, this is not just some esoteric, you know, mathematical equation pulled out of thin air. In the end, the market on an option is supply and demand. So when you think of an option, okay, people get options all twisted and construed in different ways, and it's hideous, right? Just think of an option as any other market. What sets the price? Supply and demand. If everybody demands calls on this stock, because it's called stock, if everybody demands calls, the price of the calls go up. If nobody really cares about the calls, the price kind of goes down. It is supply and demand. Sure, time has to do with it, yada, 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 but the option's trading for $3 because there's demand to the amount of $3 for it. Now, if you go out and buy a 100 call, you're going to want that stock to go up. If you buy a 100 put, let's say the 100 put's trading for $3. Now, puts scare everybody. You're buying the right to do what? To sell. Now, again, some of this is a little bit of foreign language to you. It's all right. What I want you to see right now isn't so much in context of what a 100 call does or what a 100 put does. I want you to see the prices of the options. The price of the call is trading for $3. The price of the put is trading for $3. Please add them up. What do they equal? Okay, they equal $6. Now, why is that such an important number? Because the options, okay, are putting a price tag on risk for the future. If these options are good, right, until the end of December, and these options are trading for $6, it tells you a tremendous amount about this particular stock. I know that this is, again, it's convoluted for the first time ever going through it. The 100 call is trading for $3. Why? Okay, ultimately because there's a marketplace that says, all right, well, I think the stock can move up at least $3. If the stock couldn't move up $3, then the 100 call wouldn't be trading for $3. And the 100 put's trading for $3. Why? Well, some people believe the stock could go down at least, what, $3. Now, I'm going to blank the screen for a minute. Okay? Remember the $6. On this $100 stock, and again, it's a weird example to go through initially. On this $100 stock, we have, okay, this $6, all right, price point of both the call and the put added together, right? So up here, we had this 100 call, and down here, we had this 100 put. And this is trading for $3, and this is trading for $3. Add them together, it's $6. What that basically does when you add them together, it is equivalent to what we term expected move. Now, all right, I don't want to hear about any indicators, nothing like that, okay? What I want you guys to see is this. The option marketplace is a very, very bright one. The option marketplace, and again, don't let this get past you. The option marketplace is putting a price tag on risk in the future. Like, let's say these options expire, because eventually all options expire. There's options for a month and 2 months and 3 months. There's options even a year out. But let's say these options expire again in December, and you're paying $6 if you bought both of them. What that's ultimately telling you, okay, is what a 1 standard deviation move is. It's actually, the options are putting a price tag on risk to this future date. It's saying that the marketplace believes that this stock could possibly only go up $6 or down $6. Okay? And don't even worry again. It's not important to understand if the call goes in the money or the put goes in the money. We're not even going to trade these options. I don't need no stinking options right now. All I needed was the price of the options, okay, to determine what is called expected move. Now we're going to go through a number of examples. So let me guys know right now, okay, right here, right now, are you okay? If you're not okay at this point, you can say, no, I don't know what I'm doing, okay? Are you okay? And you just, because again, when you're going through this, way good. All right, awesome. So all we're doing over here is just pricing the call and the put at $6. Now, I'm going to go beyond this slide because after this, things get a little crazy. All right, I got 1 or 2 no's. For the 1 or 2 no's, it's all right. We're going to actually go through a number of other live examples. Okay? Expected move and probability. So a moment ago, the options told us, all right, that at the money call and at the money put, it told us what terms expected move. And that's a 1 standard deviation. That's 68.3% of the time. You're like, by the way, I hate these definitions, but I'm required to throw these definitions. No, because these are the marquee definitions. If you see this expected move of plus or minus $6, like we did in the previous example, okay, and the expected move is plus or minus $6, you have to add the call to the put. You have to add the call to the put to achieve the full $6 expected move. And I'll show you that here momentarily. Therefore, there's a 68.3% probability of an underlying closing inside of the expected move by the designated expiration. Expected move is a probability of expiring inside a given range by a specified date. So if I bring it up this way, okay, what I've done is I've defined that this stock, which is this $100 stock, can move up $6 or down $6. But it's only going to stay in that range, what? About 68% of the time. Okay? That's all I'm trying to do to begin with. And again, this gets easier because you're like, so I add the call to the put. Don't worry, we're actually going to show this in live because, in a couple of live demonstrations. So the reason I spend so much time on this is I'm telling you right now, expected move, hands down, is in trading right now the most critical calculation you could possibly use. I don't care whether you trade stocks, whether you trade options, whether you trade futures products. I do not care. It is imperative to understand expected move because how can you possibly be involved? Like you're like, well, Don, I trade me some Microsoft. Okay, so Microsoft has an expected move. We'll look at it in a moment. I trade Gilead Sciences. That thing is wild. Expected move. Let's go find it. Because you have to know what's being expected in a particular product. And we'll show you the relationship here. Now, expected move. Now, not every trading application has expected move. You can use what's termed an at-the-money straddle as an alternative to the expected move. Add the at-the-money call and the at-the-money put for any selected expiration cycle. Okay, let's slow down and show this on a trading application. So, and again, I'm going to show you a bunch of different examples, and I'm going to let you guys bring up different examples. The straddle price and expected move. This by the way, the application that I'm using here, it's the thinkorswim trading application. It's, by the way, it's not essential that you guys use the thinkorswim trading application. Okay? Yes, I spent a lot of career time there. There's a lot of features on thinkorswim. You know, I was right there. We're like, oh, let's build this, let's build this. But it's not essential because you can do this now. Like, technology has kind of become commoditized, right? So you could do this really on any trading application out there. It'd have a mobile application. As long as you have an option chain, you could do it. And I'm telling you, you may never trade options, but you're going to look at markets differently after today. This is Facebook. It's the Facebook, okay? And I took this screenshot a while ago. It doesn't matter. There's an expected move calculation on thinkorswim, okay? It's on the right-hand side of each screen. It says plus or minus basically what? Plus or minus $7.96. But you don't have to do that. Listen, the stock is trading right here. It's trading right around like 124 and change. Just add the 124 calls to the 124 puts. Add them up. Look, $3.40 plus $3.90 equals pretty much about $7, $7.30, which is really, it's not perfect, but it's really, really close to the definitive calculation for expected move. We okay? All right? And by the way, somebody's saying, what's the 21%? That's the implied vol. That's the number that's used in the equation over there. That's a great question. Okay? So, again, all we do is add the call to the put. And I'm going to show you, like, all right, does this stuff work? Well, here, expected move examples. Let's look at a few stocks and determine expected moves. Now, you guys call it. You tell me. By the way, do I always split the bid-offer spread? Thomas, yes, I do. Split the bid-offer spread. Use the mid price. Okay? Oh, yeah, look at this. You call it. What products you want to evaluate? Gotcha. Raja, Caterpillar. You know what? I got to bring up Caterpillar. You know why I want to bring up Caterpillar? Don has a position in Caterpillar. I've got a position in Caterpillar. Name the date. Come on. Come on. What date you want? Let's go exactly. We'll go 29 days out in Caterpillar. Now, Caterpillar's trading. Listen, I'm going to mark up the screen here a little bit. Caterpillar's trading right at about what? $96. Okay? Now, I can come right over here, and I can see in 29 days from now, all right, the expected move is plus or minus, what, $5.91. It's basically like a $6 expected move. And by the way, this is funny because this is almost like the example that I did, right? I took a $100 stock. Well, here's a $96 stock with basically plus or minus a $6 move. Got it? Now, if you could do this, it's almost a $6 move, but you could also just add the calls. You could add those calls to the puts. This equals $5.26. Now, look, there's a little bit of difference between the $5.26 and the $5.90. Yes, but, okay, let's not split hairs too much. Breathe, okay? There is about a 70-cent difference in here. But this, adding the call to the put is fine. Listen, when I started my career, that's all we did. We just added the call to the put. And it told you that the stock was going to move plus or minus $5.26. You realize this is a $100 stock. So being off by about 60 or 70 cents, that isn't exactly going to like make or break you. Got it? Okay? And again, really kind of comes into, oh yeah, somebody was saying, what's a EM? So EM, expected move, market maker move, they're really almost the same thing. Anyway, so that's, you know, Caterpillar out there. What else do we have? What other, oh, somebody asked for Amazon. Okay, Amazon. Let's do an example here. Close this up. Amazon. What expiration? Okay. By the way, I'm using the mid between the bid and the ask. So what expiration? Let's do 15 days out. 15 days out. There's plus or minus basically $33. And let's do it the other way too. So here we have $43.65. So what do? Do you do the 42 half? Do you do the 45s over here? Again, breathe deeply. Like, this doesn't have to be an exact science, right? Add the 45 puts to the 45 calls. Take a look. The expected move here is basically $30.73. Up here it says basically 33. All I want you to be able to do at this point is just determine that, okay? if you have a little understanding, all this means is that Amazon is highly anticipated to move in about a $33 range. Okay? It's highly anticipated to move. Now, this has nothing to do with direction, because somebody's like, well, what about a 3-day or a 5-day period? It has nothing to do with direction. I'm not telling you the stock's going to move up 33 or down 33. I'm telling you it's going to move, okay, in a range of plus 33 or minus 33. And if you know it's going to be in that range, right, how about we come up with a strategy to peg it in the range? Now, what I'm about to get into, people, listen to me very carefully. This is about to get deep, okay? This is where I literally argued with myself internally if I was going to do this, but I'm doing it. So here we go. The down and dirty on volatility. Traders and investors alike spend tens of thousands of hours consulting charts trying to figure out the next move. Should I use this? Should I use the RSI Laguerre? Should I use, a MACD, a Fibonacci, a Bollinger Band, the stochastic, the Elliott wave told you to do it, right? Well, options pricing and volatility, they give you a real skin in the game marketplace on what the world perceives risk and movement to be. That's the down and dirty about it. Like, listen, people ask me all the time, they go, well, why was that Amazon straddle trading? Why was that Amazon straddle trading for $33? Why was the expected move on Amazon $33? I'm going to tell you right now why it's at $33. Because the marketplace pegged it at 33. Now, let me ask you something. What would you rather trust? Would you rather trust the chart that goes, there's your chart. Would you rather an actual marketplace that have hundreds of millions of dollars at risk? You tell me. Seriously, what would you rather? Would you rather trust like what happened in the past, or would you rather trust an actual marketplace? They're putting a definitive price tag on risk and movement to be. Am I right? Okay. Got pretty quiet out there. Everybody with me? Because we're getting pretty hardcore. Next question. Does this stuff really work? Let's take a look at a few recent examples in the SPX options. Dun, dun, dun. The SPX. By the way, if you don't know what the SPX is, you're okay. The SPX is the S&P 500 index options. It's the mother of all option pits. That's where I started. Okay? It's the SPX is by far and away the largest, okay, most, well, in terms of volume, by far and away the largest. All right? I mean, the volume in there every day is monstrous. Also, the SPX is a $2,200 product. So people look at Google like, yeah, Google's 770, or, they look at something like Amazon, oh, it's 745. That's nothing. This is a $2,000 product. First of all, okay, we want to really know if this stuff works. Would you agree that the recent presidential election trading week was rather insane with volatility? Yeah, more hardcore. Oh, people are asking more. More, okay? Would you guys agree? Right, presidential election was pretty insane with volatility. Let's look at what the expected move on the SPX was days prior to the election, then see if markets move as expected. Got me? Here we go. This is the SPX the week of November 6th. By the way, consult a calendar, okay? Because what was November 6th? If you're unaware, again, we're just looking at very recent data here. November 6th was a Sunday evening. Okay? It was a Sunday evening. And this screenshot right here, this is actually out of thinkorswim. It was a screenshot taken on the Sunday evening. Why the Sunday evening? Because the data is then saved from Friday. So this is just Friday saved data. The SPX on that Sunday evening was trading at 2085. Now, I want you to think about what happened the week of the presidential election. On Monday, okay, by the way, on Sunday, I have to say this, on Sunday, right on, okay, 11/6. This is when the FBI news came out. The FBI news said Hillary Clinton is no longer under investigation, yada, yada. You knew the market was going to explode higher. But what I want to know is not just about Monday. I want to know the entire week, okay? So what we're looking at now, and again, no one on Friday, nobody, this data was saved from Friday. Nobody on Friday knew about the FBI stuff. Nobody on Friday knew the outcome of the election. The SPX was trading at 2085. The date, you got it right there, okay? The expected move, look on the right-hand side of your screen. Look at it. What does it say? 71 bucks, okay? There's 5 days until expiration. Now, grab this, okay? The SPX price movement, all right, or the SPX price November 11th, 2016. This is exactly 5 days later. This is a screenshot, okay? In one of the most volatile weeks in recent history, the U.S. presidential election, the SPX options markets pegged the movement in near perfect fashion. The expected price move, all right, was pegging it at 71. Remember, it was looking for a $71 expected move. The actual move was $79. Not bad, considering it was the largest unexpected event in recent history. So the one thing that people are missing over here is that, again, this is a totally unexpected event. Number one, the FBI rally was unexpected on Monday. Number two, the presidential election, we were all told, if he wins, the markets are going to tank. They didn't tank, they rallied. But the expected move didn't care either way. The expected move just said 71 points, higher or lower. We moved 79, pegged it. Okay? You have to realize something about the SPX. This is a $2,164 product. Missing it by 8 points, okay, on a statistical level, missing it by 8 points is nothing more on a $2,000 product than a rounding error. They hit it on the button, and that's the most important thing. And I'm going to show you why this worked. Okay? This is the SPX the week of November 27th. You're like, wait, go look at a calendar. This was actually taken, all right, just the other day. What was November 27th? Okay? Go look at the calendar. Everybody now is consulting the calendar. That was Sunday night. Again, I like to use Sunday night because it's a good time to take a screenshot. Here we go. Here's the SPX. Once again, it's trading at 2213. 2213. Now, this is a one-day option. November 28th expiration. See, it's kind of neat. Whether you know this or not, this is a Monday expiration we're looking at. We're looking, right, to see on Sunday night, the market was projecting about a $10.30 expected move. Okay? What actually happened? That's this week. Expected move with 1 day remaining till expiration was $10.29. The actual move was $11.63 as depicted below. Again, SPX, okay, basically came into, oops, I apologize, that's the wrong number over there. It's not the 2085, the SPX over here. I did not change the screen, okay? The SPX came right there, 2201. The actual move was $11, and there it is, 63 cents. So again, and I apologize for the mistake in the PowerPoint over here, but if you look at the SPX on Sunday, it's 2213, okay? Here it is at 2201. And by the way, feel free to consult. The trading application was down $11.63. It missed the expected move by pennies on a $2,200 product. It's off the charts. We could go all night with this. I could show you expected moves, have projected the closing prices for the SPX all night. The expected moves are what we term statistically significant. Statistically significant means we've done our homework and these expected moves are happening consistently. How does it work? More importantly, how can we translate expected moves into us making money? All right? Again, all I'm doing right now, and I'm going to take you to a live trading application, and I want you to look at the SPX. All right? Listen, the SPX, tomorrow's Friday. Okay? Tomorrow's Friday, and there's a $10.73 expected move. Could the market tomorrow move further than $10.73? Yes, it could. But I'm going to show you why there is such statistical significance around the SPX. Okay, and you're going to want to look at this in the SPX. It's critically important. I'm going to show you why. Again, I want to show you how it works, and more importantly, how you can translate expected moves into us like making money. It's the most important product in the markets. The SPX is the single most important product in today's marketplace. Okay? It's not Apple. It's not Google. I am telling you, the SPX option product itself is moving the entire market. And I'm going to show you right now why. The SPX is a $2,200 options-only product. I'm not telling you right now that you have to trade the SPX. Okay? Not telling you that you have to trade the SPX. I am telling you need to understand why it's moving the marketplace. Okay? We started off the night calling this market manipulation, and I want to show you what's manipulating the markets. There is no stock. This is not an ETF. Why is the SPX the single most important product? Allow me to present to you some really invaluable data. Data matters. Listen, I don't care what somebody, oh, well, this guy said it could be this, it could be that. Here's data, okay? Proof is in the pudding. Here we go. Why do SPX options have so much importance? In 2016, why that's this year, the average daily options volume for the entire market, not the SPX, the entire marketplace, okay, has really been, it's right around 16 million contracts per day. By the way, I wanted to show you something, okay? I originally put down 15, okay, 0.96, but I took another screenshot, and this came directly from the OCC. That's the Option Clearing Corp. It's an email I get every day. The 2016, okay, year-to-date average is really roughly 16.2. I wanted you to see there's a very, very mild difference in there. Since I originally put this together, okay, the volume moved up very, very minimally because November was such a wild month. It actually added a little bit more juice to it. So look at November, almost 20 million contracts a day. By the way, this is per day. So I want you to remember this number. Just remember, 16 million contracts a day in the whole marketplace trade. 16 million contracts a day in the whole marketplace trade, not just the SPX. 16 million per day in the whole market. Okay, November 21st, 2016, the SPX volume was 1.257, 484 contracts. This comes, okay, from a screenshot of the Chicago Board Options Exchange data. Now, the reason I picked November 21st, it was neither here nor there, whatever. It was a Monday, okay? I picked November 21st because I picked it in this slide, and I picked it in this slide. It was just it was the easiest thing to do, right? Again, it takes me a long time to put all this data together. So 1.2 million. So I want you to think about this right now, okay? 16 million contracts traded per day in 2016, but the SPX options are averaging approximately 1 million of those contracts. Just about, I'm averaging, right? So what do you have? Okay, you have the SPX doing about 1/16 of the total volume. You guys with me? I told you that this is going to get a little hairy. Okay, the SPX doing about 1/16. The only difference, though, is the SPX, it's a $2,200 product. Do you know what that means? It means the SPX contract size is 20 to 30 times the size of the average option contract traded. Let me show you exactly what I'm talking about. Here's the SPX. Now I don't even know the contracts in here today. Look, there it is. This is today. Today. Look at the SPX traded, 950,000 contracts. Okay? Go look at Apple. AAPL, enter. Apple traded 374,000 contracts. Apple's a $100 stock. What's SPX? $2,200. Okay? Apple's what? It's minuscule. Apple's not even a 20th the size. That's why I say the SPX contracts are roughly 20 to 30 times the size of the average option contracts traded. And wait. The SPY tracks the SPX, accounting for an additional 3 million contracts plus per day. Are you guys with me? Are you with me? Are you with me? Are you with me? Okay? Again, by the way, don't look at the NDX because it's bad. The spider tracks the SPX, and it's an additional 3 million contracts per day. So do the math. You have 1 million, and again, follow with me here. You have 1 million SPX contracts. You have 3 million spider contracts. That's 4 million total contracts. Now, what was the total, okay? Of the 16 million contracts traded per day, over 25% of the daily's options volume, okay, on any given day is directly related to the SPX and expected moves. So right now, we have 1/4 of the total contract size every day related directly to the SPX. But here's the crazy thing. Because the SPX is a $2,200 product, because it's a behemoth product, it's what we term in terms of notional value, the SPX options account for 60% of the total value traded per day. Recall, the SPX options are 20 to 30 times the size of standard option contracts. Now you're like, it's not 1/4. It's really over 60% of the total liquidity that trades on options. There's 16 million contracts a day, but 60% of the value is traded just in the SPX. It's crazy. Now, this is the most interesting part of it. You ready for it? Dun, da, da, da. Here we go. Okay. Okay, so it's really, really big. You got it. What changed in the markets? I told you guys before coming to this webinar, there was manipulation and structural change. Structural change. This is PR, okay? Here it is, PR Newswire. The Chicago Board Options Exchange today announced it plans to list Wednesday expiring weeklies. It begins February 23rd of 2016. These have Wednesday expiration. Now, they've had Friday expirations for a while. The Friday expiration started a long time ago. Then, February this year, they added Wednesday expiration. Wait, PR Newswire, July 11th, 2016. Chicago Board Options Exchange liked the Wednesday expiration and Friday expiration so much, well, hell, they added a Monday expiration. The Monday expiration, I'm telling you, no one in the entire marketplace has this data. Why? It just started in August. Okay? They now offer Monday, Wednesday, and Friday expirations. Why is this so important? Why is it so important? So we looked at the sheer magnitude that 60% of all the option contracts that are trading have to do with the SPX. Now they have a Monday, a Wednesday, and a Friday expiration. I'm going to show you exactly why. This is going to baffle you a little bit. Behold, the SPX options have changed the game. Years from now, traders will be likely discussing how the addition of multi-week Monday and Wednesday, as well as Friday, weekly options in 2016 changed the game. No one's talking about how the efficiency of the markets is far beyond, okay, that of ever recorded in the history of this business. Okay? Here's the crazy thing, and one thing I have not yet alluded to. There's supposed to be 68% of all occurrences in one standard deviation. There's not right now. There's closer to 88% of all occurrences. 88% of the time we're ending up in one standard deviation. Our research attributes, okay, the level of efficiency to the onset of multiple weekly expiration, Monday, Wednesday, and Friday options. As market makers, hedge funds, risk managers are hedging their collective risk using these options. You see, what it comes down to, all right, and I'm going to give you a summation over here. The marketplace is now getting a price tag on risk for Monday, Wednesday, and Friday. And all the market makers and the hedge funds and the risk managers, they never had this data before because the data never existed before. Why did the data never exist? Because the product didn't exist, people. The product is brand new in 2016. So all of a sudden, they add these weeklies. And you know what the weeklies do? It changes the entire marketplace. The SPX options are expiring 3 times a week. There's no give or take. The additional option expirations, Monday, Wednesday, Friday, have changed market behavior via creating relatively measurable market moves via looking at the expected moves. We've all looked at the expected move. Okay? TheoTrade has developed a low-risk strategy to envelop the expected moves. It's a pretty key logic over here. Again, when you start looking at the expected moves, what I'm getting at here, forget about Apple. Go to the SPX. You never had 1 day, 4 day, 6 day, 8 day. You never had this before. Okay, think about it, right? There's 1 day, 4 day, 6 day, 8 day. It's not leaving much to chance for the market makers. What they're doing is they're saying, okay, we're expected to move $30. Let's hedge against that number. We're expected to move $25. Let's hedge against that number. They never had this data before. And when I say hedge against the number, they're out there buying and selling options, okay, like mad people. Look at the size of the volume. Just 13 million contracts, okay, or sorry, 13,000 contracts, 19,000 open. This option only has 1 day to live. The 4-day options, they're trading right now in the heaviest fashion possible, the shortest expiration. It's moving the markets, okay? It's manipulating the markets. That's what this is about. Again, we developed a low-risk strategy kind of envelop these moves. Position yourself around expected moves. Again, let's get down and dirty. How do you position yourself most effectively around the SPX expected moves without absorbing large amounts of risk? Let's not get cute. This is pretty serious because millions are up for grabs. Butterfly spreads. We will use standard low-risk butterfly spread in order to take advantage of the SPX weekly expected moves. The idea, it's easy. We want to achieve maximum reward for very minimal upfront cost. The butterfly spreads around expected moves just scream, limit your exposure, maximize your potential. I mean, that's what it's about, okay? The Butterfly's Guide to Expected Moves. Now, tonight's presentation, it displayed the setup for the butterfly. You may or may not know a butterfly. It's an age-old option strategy that takes on, again, very minimal risk, right, and creates potentially massive returns. The butterfly, it's not just about the butterfly. It's in conjunction with the correct understanding of the SPX expected move can be an incredibly powerful combination. This is what a risk graph looks like. Now, I'm going to be very forthright on this risk graph. This is a butterfly risk graph, okay? Very minimal can be lost. Huge possible returns. You're not going to make the full return. Listen, this is taking roughly $55 of risk to be able to make upwards of 1,000. We're not going to try to make that. We're going to turn 55 bucks. We're going to try to make about half of this. Okay, we're going to try to take 55 bucks and turn it into about 500. And how do you peg, all right? How do you know the underlying is likely to go to 2160? Oh, you'll never guess, because I can actually center around the expected moves. Again, here's the strategy and the characteristics. Characteristics of what we call butterflies around expected moves. First of all, if you've never seen a butterfly spread before, don't worry about it, okay? This is the actual butterfly spread. I told you, it's trading for right around 55-cent debit. It's going to cost you 55 cents. That's for only one contract. But as I showed you a second ago, one contract, okay, can still do a lot of damage. Like this is one contract. If you hit it right on, could make 1,000 bucks. You're not going to hit it right on. We're going to be buying and bailing out of these things. But the butterfly has historically speaking been a lower probability trade. Okay? The butterfly, again, historically speaking, has been a lower probability trade. However, the knowledge of expected moves provides the savvy retail trader an edge, significant profit potential with minimal moves in the market. You have to recognize we're not looking for a big market move over here, right? And by the way, people are like, oh, have this been done a long time? You have to recognize these products have only been added, okay, coming into February of this year. August was a Monday. So now we have Monday, Wednesday, and Friday. And the most essential thing is there is a Monday, Wednesday, and Friday expiration. That's what changed, okay, the marketplace. The trade can be placed multiple times per week. You need not closely monitor, okay, these orders. You can actually exit what's called GTC, which is good till canceled, okay? The trade loses minimal capital if the markets make massive moves. We are going to go out there and we're going to buy the butterfly for a very small debit. You're not going to get cute. You know, people have heard of stuff like, I'm going to do me a broken wing butterfly, I'm going to do me this. I am intimately familiar with all the different strategies out there. Can I tell you guys something about options? There's calls, there's puts. You can buy them and sell them. That's it. There's calls, there's puts. You can buy them and sell them. At that point, what's more critical in this strategy, you have to understand that this is about the expected move. All I'm doing is playing target practice with the expected move. And I'm using a very slick little strategy, okay, to do that with very minimal risk. If you're wrong, whatever, you're going to lose minimal capital. In massive moves, you're going to lose minimal capital. Doesn't matter. You're not going to hit right on. You're going to try to take 55 bucks, right, and turn it into $300, $400, $500. It's an excellent tool for looking for potentially large returns on weekly options. And it could be done 3 times a week now. And that's the thing. Like I showed you on a Sunday night, you could place a trade on Friday afternoon. On Monday, it's done. Okay, you don't even necessarily have to close it because of the SPX. And we can show this in a lot of different products. But building the butterflies around expected moves. Do not let options intimidate you. The spread below is being done for a 55-cent debit. That's 55 bucks for one contract. However, I want you to realize this spread is kind of akin to a massive chainsaw. Used correctly can be extremely effective in creating returns. Used incorrectly, you know, you're going to cut off a couple of fingers. You need to know how to use the butterfly and, more importantly, how to build these trades around the expected moves. And I want you guys to know that. Like, this is not, again, instant coffee, instant tea. I started with that tonight. You got to build these around the expected moves. And you have to know how to calculate the expected moves spot on. That's what that butterfly is about. Fear not the butterfly spread. Again, you don't know options, it's fine. You have limited experience in placing option trades, that's fine. We can show you how and when to place butterflies around expected moves in a matter of a few hours. It's a few hours to do it. TheoTrade, what we do is we create detailed recipes for every strategy, including butterflies, surrounding the expected move, okay? And I always, when I talk about recipes for trading, or when I talk about what I call criteria, you know, it's the same thing as baking a cake. You wouldn't bake a cake without a recipe, you know? So why do people trade without one? And that's what we do at TheoTrade, right? Criteria, it's what we do, okay? Trading, it's all about answering these what ifs. What might be a good stock or ETF candidate for a butterfly around expected moves? Oh, I have one idea. It could be the SPX. What's the correct options expiration cycle to buy my butterfly? Now, there's Monday, there's Wednesday, and Friday. But when do you initiate each one of those? I'm going to tell you right now, you can trade Monday, Wednesday, and Friday. It's the initiation, okay? Because the research points to the entry of the position. You have to basically enter a Monday spread on X day. You have to enter a Wednesday spread on X day, okay, to get the most value, the most bang for your buck. How much capital do you commit to the butterfly spreads? What option strikes do you sell? What option strikes do you buy? I mean, that's what we do, is we provide the answers to all the questions. What's the right probability for the trade? How many option contracts do I trade for my account size? Well, you know, you can do a butterfly spread with $2,000 in the account. Doesn't matter. When do you close the butterfly spread? What if the markets move really big? The options that I basically traded go in the money. What's the correct return for the strategy? Do I go out? If you pay 55 bucks for the thing, do you get out when it's worth 200, 300, 400? You know what? If the stock rallies massively, then of course, inevitably somebody says, can I fix a losing trade? Of course, okay? But is it worth it? We have all the answers, okay? That's what we do. We have answers to the trade-related questions. We build recipes, definitive criteria, and checklists for each strategy, okay? We build, like, you know, if you're a pilot, you go into a cockpit, you start ripping through the checklist, okay? It's how, when, why, at what price. This is just the beginning of the many variables you'll face while buying butterflies surrounding expected moves. And really, the secret's in the sauce. And you may be thinking, yeah, you can read about these spreads. I'm serious. You can go Google right now what a butterfly spread is. There'll be 5,000 sites that come up about what a butterfly spread is. But think again, because I'm telling you, the strategy itself, that's nothing, okay? It's all about the criteria. And I always point that out, because in options trading, there's a call, there's a put. Oh, wow, it's a butterfly. Okay, it's an iron condor. It's a mambo combo. It doesn't matter. We spent months fine-tuning the trade setup. You actually saw some screenshots that were a little older. The reason is because I've been working on this for a long time. Thought about writing a paper about the SPX expected move, and I'm like, the hell with it. I'd rather take the time to put together a class. All right? You guys want the criteria for the butterfly surrounding the SPX expected move? We've got a class coming up, and that's exactly what I've been spending my time on. It's called the Butterfly's Guide to Weekly Returns. I like it because it's taken from the position of the butterfly. We're doing a class Saturday, December 10th. Okay, it's 9 a.m. to 12 p.m. Central Time. It's a 3-hour class. I'll be the instructor. We have a lot of different instructors here at TheoTrade, but this is one I feel pretty strongly about. This is a lot of work that I've done on it. The class is archived immediately and available indefinitely. All the entry and exit criteria, the checklists, are made available immediately. Okay, the class, it's $197. We're not here to like, kill you for a class, because the class is $197. Okay. You want to go to the class, you want to do it if you can while the class is live. Yes, it's recorded, everything is available immediately, but in addition to this, okay, again, it's $197, but in addition to it, we're giving you, okay, the Options 101 class. It's called the Basics and Beyond. We're also giving the Options 201. It's to get you ready for the butterfly. We also will give you Options 301. It's Volatility and Expected Moves. Okay? There's some pre-work that you want to do. And I'll tell you what, so you're looking at this right now and you're like, well, it's December 1st and you got 10 days before the class. You'll need it. It would really be beneficial for you to watch 1, 2, 3 videos prior to it. So you know the Options 101, that's a 5-part series. Okay? It's 5 45-minute sessions. Options 201. Okay, I think that one's a 4-part series. Okay, bonus number 3 over here, Options 301. It's about 3 hours long, Volatility and Expected Move Essentials. This is hardcore stuff. We put that together, again, because we want you guys to be effective in there. By the way, the web address is theotrade.com/fly. Now, what the class is actually about, here's some of the curriculum. First of all, class is going to go through, and I'll throw up the theotrade.com/fly. You can go right to the web address right now. Again, it's $197. You're not going to go wrong. It's actually 4 classes that you're taking in there. But in the class, you're going to learn how to use the butterfly spread. It's like really minimal risk and produce some really big returns if you hit the butterfly. But you got to discover the structural changes. And that has to deal with the SPX and how these changes have altered the landscape of the marketplace. I'm going to get into that for this 3-hour class. An hour of it is going to be discussing the expected move and how we can actually peg expected moves. Okay, the butterfly, I did a lot of research. I couldn't find anything better than the butterfly to peg the expected move. Understanding how markets, okay, do provide predictable or what we term manipulated ranges in any stock, ETF, or index. By the way, we're also going to talk a little bit about, well, some stocks out there. We're also going to get into build your own butterfly spread. A good 2 hours of the class, build your own butterfly spread around expected moves, and it has detailed step-by-step entry and exit criteria. When we say that, what is detailed step-by-step? It says step 1, step 2, step 3, step 4. It says, how do I place this trade? Literally, how do you place the trade? Order execution. Then it takes you through all the exit criteria, right? Exit criteria, step 1, step 2, step 3, all the different exit variables. What if the stock goes up? What if the stock goes down? What if it stays flat? What if expiration's coming? You're going to be able to read market risk like never before, okay, with insights beyond any classes available anywhere. Now this, that's a bold statement right there. Need to read the market risk. This has to do with expected moves. Nobody's looking at this stuff. Everybody's looking at like, what does the Fibonacci say? Come on, Fibonacci's been around since the beginning of time. Literally since the beginning of time. This brand new. How can you trade several times per week? Well, without having to continually monitor the positions. It's what we call set and forget positions. That's actually an important portion of the course, is that you want to know that you don't have to sit in front of the screen. We're going to set them, okay, and let them go. Set them and let them go. Discover how to create trades based on expected moves and not purely direction of the market. And trades can be done in retirement accounts. They can be done with minimal options experience and smaller accounts looking for larger upside potential. Okay, that's really the curriculum of this particular class. Now, in addition to this, we also offer something that's quite spectacular. So all that we're clear over here, what are we clear about? The class, everything is recorded, and you will have access for eternity to this class, and you will have access to 101, 201, 301. Or would you like to access every class we have ever done, and access to every class we will do for the next year? Okay? We offer something in addition. If you want to take the class for $197, well, it gives you that class and the 3 other classes. Or you can select to just go for everything. We do something that we call Total Theo. Okay? What it does is it gives you the class that we just discussed. It gives you all the bonus classes, but it also has every other class we've ever done. Okay? What that means is there's essential skills for consistency in trading. We did a class a few months ago called the Risk Twist. It's called the Next Big Short. Some of you guys probably went to that. We have a guide to selling high probability spreads, an extreme volatility class, an iron condor class, a sell premium class, there's a covered calls class, weekly options class, fractal energy. Okay? Listen, I'm an options geek, and I know I'm an options geek, so I surrounded myself with some great market technicians. Doc Severson works here, okay, with us at TheoTrade. Jeff Bierman, total technical analysis geek. He spent 7 years working with me at thinkorswim. He helped build a lot of the thinkorswim charts. He also does classes, increasing vertical spread probabilities, technical analysis. That's a Doc class. Small account, top 10 skills for growing a small account. Weekly diagonals, RSI Unleashed class, another Doc class. Essential skills, okay, and a minimum of, again, 1 class per month. Again, a minimum of additional 1 class per month. The whole thing is $997 for everything we do. By the way, in addition to this, we even email out trades to you, and I'll show you guys a little bit about it. So here's actually, again, if you go directly to the site, make sure I've got the web address up here. It's just theotrade.com/fly. I like that one. theotrade.com/fly. By the way, we're also our email or support. Okay, here we are. You can talk to us right now. If you just want to go through the class, it's $197. Again, we've gone through all the different bullet points. The $197 also includes 101, 201, and 301. Okay, and I'm going to answer some questions here in just a moment. What we also try to provide is this. Listen, there's all kinds of education out there in the markets. We are a very different, we've taken education from a very, very different standpoint. And I'm going to make you aware of it right here, right now. The difference of TheoTrade is this. We are heavily backed by brokerage firms. Okay? It's very unique. We're not here to sell you a bunch of classes. You will need nothing after this class. I want you guys to know something. Whether you go to the $197 class or you pay $1,000, we don't offer anything beyond the $1,000. That's for an entire year. That's every class that we've ever done. Every class we've ever done, and every class we're going to do for the next year. And the reason other educational companies will charge you $1,000 per class, which is insane. How do we do it? It's because I spent 15 years in the brokerage industry. Everybody in this brokerage industry wants to work with TheoTrade. We currently have agreements in place with a number of the major brokerage firms, including, but not limited to, TD Ameritrade. Okay? TD Ameritrade, it's the one I'm most familiar with. If you don't have an account at TD Ameritrade, that's fine. You know, we do some work with Interactive Brokers. We do some work with TradeStation. We do some work with a number of different brokerage firms. Okay? They ultimately offset the cost of your education. And that's one of the most important things. And I'm telling you why this is so important, because I'm not here to sell you a bunch of classes. We want to teach you stuff so that you trade, because the brokerage firms want you to trade. And they know after 15 years of me running an education division of TD Ameritrade, okay, they're like, oh, this guy produces the best clients in the industry, okay, and we hired a bunch of the people I used to work with over the years, you know, and that's really what we put together. The class itself, again, if you just want to go to the class, $197. Again, it includes the 3 bonuses, options 101, options 201, options 301. You'll enjoy all 3 of these classes. By the way, even if you have extreme experience, please go through the classes. Now, this is what we call Total Theo. It's 12 months, okay? In Total Theo, there's some things that I haven't yet mentioned that I'm going to mention. Bear with me for a moment. For $997, okay, you get access to every single class that we've ever done. We archive everything, okay? And when I say we archive everything, we archive everything, all right? There's nothing that we don't archive, and I'm going to actually show you what this looks like here momentarily. You just saw me bring up another web page. We archive everything we do. Now, what I have not told you about yet is not only do you have access to the classes, okay, you have access to our live chat room. Now, you may not have time to do this every day. I get it. But we do coaching sessions every day. We typically do 1 or 2 coaching sessions every single day, minimum of 1 coaching session. A coaching session is like a small class. That happens 5 times a week. We broadcast on average 5 hours per trading session. Okay, if you're not there for it, that's fine. We trade all day long. We also email out trades. So if you can't watch your screen, like you're like, I'm going to miss the chat room. Listen, the whole entire year is $997. There's chat rooms out there. They'll charge you $1,000 a month, plus classes, plus this, plus you got to buy an indicator. By the way, did I tell you we give you all the indicators away? If we have an indicator that we use that's quote unquote proprietary, there's no sacred, cow over here. We'll just give it to you. I don't care. I'll give you all the indicators. I enjoy it. You know why I enjoy it? Because I worked in the brokerage business for years, and there's no sacred, sacred goose indicator. If anything costs you a few $100, walk. We'll give it to you for free. And I love it, okay? Because you need studies, you need scans. It's included in it. Like, I don't want to have to nickel and dime anybody. The brokerage firms don't want their clients nickel and dimed. It's good. We'll actually email you out our trade ideas. Today we did a trade in the VIX. I think the other day we did a trade in American Airlines. A couple of days before that, we did a trade in Caterpillar. All 3 of these were emailed out. Those emails, okay, are sent because you can't. Some people work for a living. We email out the trade. You look on your phone. You go, okay, I want to do it. All you have to do is copy and paste the trade. That's it, if you want to do that. Now, we're not also just about options. We have stock specialist Jeff Bierman. We have a future specialist, Tony Rago. Okay? We have Slim Miller. Anybody ever heard of Steve Miller? Steve Miller actually works with TheoTrade now. He's a cyclical analysis guy. So if you guys are into Fibonacci's, if you're into, I was poking fun at Fibonacci's earlier, but if you're into cyclical analysis, okay, market cycles and so forth, Steve Miller, okay, works with us. Tony is our futures expert. Jeff Bierman's technical analysis. Doc Severson. Doc is actually cross between technical analysis and an options geek over there. I'm on there every single day, and none of us, we don't skip a beat. We just keep doing this every day. We don't take a lot of vacations, nothing like that, okay? I mean, I don't know, Doc's been working with us the better part of the year over here. He hasn't taken off, but I think one day he moved. He moved. He retired and moved. Anyway, he retired to a different location and moved, but still works every single day. Anyway, the entire thing for the whole year is $997. So I'm going to answer a couple of questions in here. And again, I love talking about Total Theo because every single day, and I'll let you guys see what it looks like. This is what our membership area looks like. Okay, here's the actual chat room. This is the chat room waiting for the broadcast to begin. All right, everybody in here, they talk to one another, so you can talk to us, but this would look like a live TV screen. The archives, this is what the archives look like. You go into the class archive, and if you're part of Total Theo, you get access to this. Okay, if you want to see the guide to getting short and collecting income, just click on it. Sounds like a cool class. I like it. Okay, so I did it. Here's the actual archive. Okay, it just starts playing right off the bat. You can click to download the slide deck. If you want to see other class lives, or maybe you like Steve Miller, or maybe you like Jeff Bierman or Doc Severson, but what does a coaching archive look like? Well, if you go into the coaching archive, here, let's hit it with, let's go back a little bit. Let's go back to March. I don't know why I picked March, right? In the coaching archive, you name a topic, we've done it. Preparing for your trading day, order execution, okay? Here, positive and negative gamma. when to exit a trade, calendar spreads, good trades gone bad, expiration position analysis, capital allocation, rolling vertical spreads. If you name a topic, this is 1 month. You name a topic, it's covered in here. Okay, everything's searchable. Okay, go to town. If you need charts, if you like charts, all of the links to all the charts on multiple platforms are right here. Once you're a member, just come in here, go to town. I mean, listen, every one of these things is explained in here, what they are. All these are, if you want to know unusual put options activity, there it is. Click on it. Okay, back over here to the member chat room. The trade tracker couldn't be easier. I just built spreadsheets for it. These are all the trades that we have opened, all the trades we have closed. Pretty easy, right? Okay, and we actually email out trades, a couple of trades a month over there. Just depending upon, hey, listen, I'm not going to be forced to email trades if there's no good trades. I did a VIX trade today. There it is. All right, cruise back over here. Again, we've got calendars, all the different events. TheoTrade tracker. When it comes to archives, you've got it. We have a Theo Dark report. This is a daily, okay, a daily blog ultimately that comes out. But I think you find these guys really, really innovative if you've never read this before. So check it out. It's we go on and on. Trump may pick. All right, for Treasury Secretary, no need for predictions. Italy risk on. Brexit Part 3. Okay. These are different articles out there. I think you guys, again, you'll really enjoy some of the content that we produce. Now, I'm going to answer a couple of questions here, both about the class. And again, I'm really excited about the Butterfly's Guide to Weekly Returns class. The one thing I want to tell you, you sign up for the class, you have got to start listening to some of the archives prior to the class. At the very least, please check out the Options 301. Even if you know what you're doing, check out the Options 301. It is worth your while. And if you want to go for Total Theo, go for it. It's $1,000. Okay, you're not going to go wrong. All right. One of the questions I love. Bill says this is overwhelming. Yeah. You know what though? When it comes to it, would you rather be overwhelmed or underwhelmed? I mean, the class itself, okay, is going to be. I think you guys will find the class pretty spectacular. But the Total Theo, it's totally overwhelming. But I want you guys to know right here, right now, that you don't have to spend anything after that. We don't sell anything else. We're not going to sell anything else. Okay? This is about being a member of something where you get all the education and everything you're ever going to need to trade, and it's all inclusive. Okay? And that's why we do it over there.